Jake? You think that there's some strong growth potential this year?
No, no. I think he summed that up beautifully, and I didn't hear that clip until right now. And sounds like our job is done. We can just play that and go, right? Um, no, that's exactly right. I mean, we inherited a mess. A mess. Things aren't going to be fixed.
Sure.
I guess to start off by just stating the obvious, when you deal with things so vast as our economy is and how it intertwines with the world economy, when one policy is implemented, it could take months, if not years, to see it come to fruition.
Sure.
And I think that's kind of where we're headed with what we're seeing right now and the Biden recession. And so the potential for growth this year is not good. I mean, we've been seeing those numbers get adjusted over the last 6 months, lower and lower and lower. I think the one I found out maybe 2 months ago was J.P. Morgan lowered. We're shooting for 3%, right? Just for those who don't know, we want 3% growth with 3% inflation. That keeps the tracks greased. That keeps everything moving forward. We don't
Yeah,
want
but the
stag.
Atlanta Fed came out 30 days ago and said that they're anticipating 1.7% growth.
That's exactly right. That's exactly right. And I think that's pretty accurate. We'll see how it plays out throughout the year, but the platform for sustained growth is not there. And it hasn't been there. And it's been confusing to all of us over the last 4 years where we've seen the stock market go up. And it just doesn't add up with the fundamental layers underneath this economy, why we've seen that. And so we've been touting, hey, the stock market's overbought. We're not just pulling that out of a hat. Here are the numbers to prove it. We've had the inverted yield curve. We've had PE ratios through the roof. And so now we're seeing this take effect, and everyone's, giving the short-term answer, the tariffs, and that's certainly playing a part in it. That's not helping things in the short term. I think we're both on the same page. We think that has long-term potential for growth and for also negotiating power, which maybe we'll touch on later. But as far as growth this year and maybe next year, I think we need to see interest rate cuts. And that's something I've pivoted on just recently because I don't, it's been another good day for gold. It's been another bad day for the stock market. I see that scenario, that storyline playing out for the foreseeable future.
Mm-hmm. Yeah, and the job report came out. Unemployment's it rose to 4.1%. They added 151,000 jobs, which is not enough. And obviously, with the Doge coming in and getting away from a lot of government jobs, and unemployment's going to continue to go up because obviously we know that a lot of the jobs, 35% of the jobs that we saw were actually government jobs, not private jobs, not working for corporations. So and Charles Payne from Fox says he thinks we're already in a recession. He thinks that cash is really dried up. We're in a tough position for cash, which is part of the reason that a lot of people we're seeing the stock market pull back because people need money to live, right? So they're liquidating their stocks, and that's causing a tumble in the stock market. And the reason I wanted to get on it because I think there's been so much about the tariffs, and I think that's everyone's saying that the recession is from the tariffs or the stock market's from the tariffs. But what I believe is that this has already been happening for a long time. And we've just been, starting to pull back some of the things that we've been crutching this economy along since 2020.
That's well said.
And I also want to say, just in terms of gold, and then we'll get back. Oh, let's talk about this right here. Let's say inflation right here. Let's look at this chart. Inflation in the U.S. since 2021 got, really high. 2022 got up to, 9%. At the highest, it was above, above 9% in terms of inflation, which these are numbers. We haven't seen inflation above 9% since the 80s. At least a government reported inflation. I've always said inflation is much higher. So you have that inflation number there, and you have credit card debt. The only time credit card debt, Jake, went down was during COVID because the government gave free money and people were locked in their house, so they weren't spending money as much. And so that's the only time in the 20 years before that we saw credit card debt actually drop. But now you can see it's well over $1 trillion.
These are the factors that everyday Americans are dealing with, and without, maybe we are not able to articulate it, but we feel it, we know it, we understand it just by the cost of living. And when you say 9%, I think, well, we look at our groceries, we look at what we have coming in and what we have going out. There's not a 9% spread there. That's much greater. That's much greater in day-to-day average American, how it impacts. And so we're just getting started with this correction. And again, what we're looking at here are some fundamentals. And when credit card debt skyrockets like that, individuals are being stretched out.
Sure.
Well, when individuals get stretched out, that spreads. And our economy is basically that. I think that we could oversimplify our economy with that comparison, because that's how it's playing out, and that's what we're going to see. And of course, those who got out of the dollar, the one thing that I think we're all dead sure of is that we don't know what's going to outperform. We don't know what asset classes we should all be in. You and I have our opinions, and that's what we're going to talk about. But we know for a fact that the dollar is not done devaluating. And that's, in one sense, not saying much, because it always devaluates. That's the nature of our system with inflation and the fact that it's a fiat currency. But we're talking about dramatic levels. We're talking about, if you hold dollars in a bank that you are not going to use, you cannot conceptualize that as a storage of wealth. It's not accurate enough. It is much more accurate to view that as a line of credit. And that line of credit is only as good as the body issuing it. And of course, when it's been abused the way it has over the last 4 years, you're losing your wealth. Everyday Americans are losing their wealth simply due to their purchasing power. And of course, that's what we deal with here with alternative assets. I'll shift gears a little bit, and because I think what we want to talk about is, again, Biden's recession. That's what we're seeing.
Yeah.
And so a little track record, if you will. This is a short summary, but basically his biggest 4 policies: the American Rescue Plan Act, March 21, $1.9 trillion. Infrastructure Investment Jobs Act, November 21, $1.2 trillion. Inflation Reduction Act, which makes me sick to say that out loud because it was very clearly the opposite. It was only $437 billion, but it was subsidized by corporate taxing for another $739 billion. So there's another $1.1 trillion. Chips and Science Act, $280 billion. There were obviously others. And there's good and bad built in and all that, right? We can argue the individual policies and where the money went, and the continued saga of Doge, I think, will reveal more. But all in all, we can sum it up as close to $5 trillion. And he's doing all this. He did all this while we were in a deficit, right? He didn't.
Right.
And deficits can be good, right? There's good debt and there's bad debt. But you simply cannot stockpile the debt. And I think what most people are, just myself included, I'm so pissed off, I'm so fed up about seeing our federal government sell out our future, our children's future,
Right.
to pay off the present.
Right.
Right? I don't run my life like that. You don't run your life like that. Again, there's good debt and there's bad debt. And at some point, too much good debt becomes bad debt. And that's exactly what's happening.
The only way we avoid this is if you just do what the last administration does, which is you just continue to add more debt and you print more money and you do more government jobs, which it's a way of masking what the real issue is. And that's, the last 2 years before Trump got elected, if you look at the big measures that Biden put into place, the Inflation Reduction Act, cutting college debt, that was just a ploy to get votes, right? That was all he was trying to do. And I talked to people that I know that are Democrats that were pissed about that college debt because, and I'll tell you, the one guy I spoke to said, big time Democrat. He said, well, I just finished paying off my debt. It took me 20 years. Why do all these people get a reprieve? And it's funny because that's a lot of times that's what it comes down to. Maybe if it was 10 years before, he would have been happy about this, right? But what about all the people that just paid it back, right? That just took the loan as is.
Well,
Um,
that's a
right. I mean,
that
that's the big thing. Let's dive into GDP. GDP, government spending. Let's dive into that a little bit here. You know, the Atlanta Fed says 1.7% growth, which obviously 1.7% growth, 4.1% unemployment. That's recession. We're in a recession. There's no way around it,
well,
right?
I think this is the crux of it all, right? Because we can approach this conversation from a dozen different angles, but it's how are we growing? How are we growing sustainably? And that's what bringing jobs in on
Correct.
our shores is all about. Something fundamental that we can then build off of and hopefully decades of sustainable growth. Again, we saw the stock market rise over the last 4 years. None of that was sustainable.
No.
Stretched out is the term I used.
But
Um,
bringing jobs, Jake, it takes 3 to 4 to 5 years, right? I mean, we're talking
yes.
about it cannot happen right away. You can't build manufacturing that quickly. You can't build a facility. I mean, I've seen it. I've seen all these owners say, great, we want to come back. We want to do it. Obviously, much easier for us, better control, better quality. Let's hire people. We're talking 40 years.
Yeah. The
So,
logistics of just getting a building built, right? And that's one of the things that Trump implemented is, hey, we're going to streamline
right,
your processes to get this done, which was brilliant. Um, but GDP, we are not going to grow while we are tearing stuff down, right? And that's what we're doing. That's what Doge is doing. That's what we're going through. We're going through line item by line item through the federal government, and we're finding out where's the poison, where's the fraud, where's the waste. That alone is going to take a couple of years. That all
absolutely.
needs to be rooted out. You're not going to have growth on top of that scenario. You've got to
Yeah,
get rid of the cancer first before you start to heal. I mean, it's the story of the phoenix. We got to burn off what is dead, and what needs to go needs to burn off. That
correct.
is painful, and that's what our Secretary of Treasury was talking about the other week when he said we're going to detox. Saying the same thing with a different analogy. And these things are going to take years to play out. It's not going to be fun if you're expecting your retirement to hold fast in the stock market. I mean, obviously, the last couple of weeks have been brutal. Do you think this is the end? I don't. I
No,
think this is just the beginning. And
yeah,
again,
this is a real hangover effect we're going to be having for a while, and I think that's that's something that people need to come to terms with. They either need to come to terms with the idea that, hey, my equities are going to go down for a while, and I'm okay with that, or I'm going to do something else. There's really just two. Because let's go to customer sentiment. Let's go. This is a good way to look at things, I think, because this is really important with all the bankruptcies and all the things happening. What are the people saying? What are people saying? And I think the sentiment index is that they're anticipating inflation, they're anticipating a pullback. Um, they're anticipating. I think they're anticipating higher inflation, which this is the real crux of the whole problem for this year. Doge, for Doge to be a success, they have to cut enough to get our inflation down, which brings rates down. That's the ultimate success.
yeah, how far are they going to be able to go to actually move the needle?
Right.
That's
Yeah.
exactly it.
And I
And
and they've cut, if you look at in terms of the tariffs, right? The tariffs are going to bring in 140 billion based on where we are currently. Doge has saved a little less than 100 billion currently, but it's not 100 billion day one. It's over many years.
mhm.
I think their goal is to get to 1 trillion. So, I think you look at Doge cutting 1 trillion over the next 2 years. The tariffs bringing in some income, which is good, and then ultimately getting rates down to help, with the real estate market, commercial, residential, credit markets, all of that, getting rates. That's the scenario that we can get out of this mess. But we're talking multiple years right now. And so
and multiple moving parts.
multiple moving parts. Exactly.
And the one thing that I haven't heard get brought up in a lot of the talk is what that chart is showing right there, the inflation expectations. I think that's a big point that everyone should start queuing into is I don't think we're ever going to have 2-3% inflation.
Yeah.
And maybe we will, but maybe it's 15 years out. And again, it's because of these policies put in place. These policies were passed several years ago, but they're implemented over the course sometimes 5 years or a decade. And when you continue to spend and borrow, even if you have some counterforce like Doge cutting down the fat and reeling it in, you still have inflationary aspects of previous administrations